You can sell like crazy and still lose money. $500,000 in revenue means nothing if after expenses, you have less than you started with. And a lot of times in a situation like that, the problem can be traced all the way back to low gross profit margins. In other words, you're not charging enough for the products you sell. Of course, you don't want to be overcharging people, but you need to bring in enough money to keep the lights on, which your customers will appreciate when they call your email for support and someone actually responds because you're still in business. And I'm gonna give you a real world example using this whiskey spice kit. It's a product that I designed and have been selling for about 15 years. I'm gonna show you how the math works out when this particular product is sold at different price points. I'm gonna show you a good example, I'm gonna show you a great example, and then we'll talk about one that sounds like it might be really good or maybe even great, but it's really, really bad. The first thing we need to do is pull up in the spreadsheet here that I have created. This is a margin calculator. I am going to link this in the description. You could build something like this if you want, but I'll just put a link in the description if you want to just download one. I've already done a very detailed video on how this spreadsheet works and filling it out actually specifically for this product. I'm just going to quickly run through the numbers and we'll get right into the heart of what we're talking about here. But the materials cost for this product are $3.98. The labor is about 85 cents when these things are put together in large batches for a total of $4.83. Of course, we're not done there. This is a product that's sold online and is shipped, so we have to factor in the cost of the shipping envelope, pulling this product off a shelf, putting it in the envelope, putting a label on it, and shipping it. If we sell this thing for 20 bucks, we're talking like $1 worth of fees there. The credit card company also charges you a fee per transaction, and then the shipping cost here, this is the average. If you have any questions on how any of this gets put into the spreadsheet or how you calculate these costs, refer to the long form video I've done on the spreadsheet. Again, a link is in the description. But let's just come on down here and look at what we're working with to start. So let's just say we're gonna sell this product for 20 bucks, right? That gives us a gross margin of 40%. If you're selling direct to consumer, this is the minimum you're probably going to want to sell something for. If you're selling this like wholesale to a retail shop that's going to be selling it to somebody else, the retail price is actually going to be quite a bit higher. It's going to have to be quite a bit higher because you need to build in a margin not just for you, but for them as well. But let's just say you're selling this direct to consumer, so it's 20 bucks. And let's kind of scroll on down here and we're going to make some assumptions. We're going to say you're going to do $100,000 annual revenue. So your cost of goods is going to be $60,000, right? Because for every dollar you make, you're keeping 40%. That's what this gross margin number means. For every dollar you make, if your gross margin is 40%, you keep 40 cents, right? So for every $100,000 you make, you have $60,000 in cost, you keep $40,000. And this might sound like a pretty good deal. You're doing well for yourself. If you pocket that $40,000, depending on where you live and how much money you need to make, this could be your entire salary for a year. However, these aren't all the costs that are involved. This is just the cost of making the product and shipping it out to each individual customer. You're going to have some more expenses than what we've logged here. And that's where this operating expenses line comes in. So let's talk about operating expenses really quickly. This would be stuff like your rent or lease for the space that you're operating out of, salaries or wages, like I said, for yourself and other employees, utilities, software subscriptions. So say you sell on Shopify and you're using an e-commerce plugin of some sort to bundle products together. That's going to cost you a monthly fee. Office supplies, marketing and advertising, shipping and fulfillment. Oftentimes people will roll this into operating expenses. I like to roll it into the cost of goods sold section up above. I've put more information in that in the longer form video on the spreadsheet. But anyway, your cell phone bill, your like professional services, bookkeeper and CPA, travel and meals, repairs and maintenance, stuff like that. Let's just say though you've bootstrapped this business, your costs are still fairly low, it's a new business, you haven't even rented a space to operate out of yet, you're just working in your garage. It only costs you $5,000 for some of the miscellaneous fees I'm talking about, and you paid yourself $20,000. You took $20,000 off the table. That means your gross profit now goes from $40,000 down to $15,000, and you still have some money left over, which is nice. However, you're going to need some product insurance. You're going to have to run a payroll, which is going to cost you money. You're going to be charged banking fees. You have to pay some taxes as well. So that stuff could easily be $5,000. So what we thought was going to be $40,000 in just pure profit, after paying ourselves only $20,000, has dropped down to $10,000. Now, this is actually not a bad scenario. You've covered all your expenses, you took some money off the table, you have $10,000 left over, which is a good thing because as your business grows, you're going to need to grow with it. The amount of inventory you carry and the way that you make and ship that inventory is going to have to grow as well, meaning you're going to have to invest money back into your business. You've got $10,000 left over from last year to put back into the business next year. You're doing all right for a new business owner. Now let's look at a scenario that doesn't look quite as good. Let's just say that instead of charging $20 for these spice kits, you decided to charge $14.99. It just had a better ring to it, and you thought you could sell a lot more. So we'll drop that to $14.99 from $20. You can see our gross margin immediately gets cut in half from 40% down to 20. We only dropped the price from 20 down to 15 roughly by $5, but our gross margin got cut in half. That's kind of a big deal, especially when we move down into this next section down here. And let's just say you do sell more. Let's say you sell $175,000 worth as opposed to $100,000. Your marketing didn't change, but the customer, your potential customer, saw that price and they were more enticed to buy it than at the $20 price point. So your sales got bumped up to $175,000, but you moved almost twice as much product, meaning almost twice as much work went into that same operation at the lower price point and the higher volume. You couldn't quite get it all done yourself. So you had to spend an extra $5,000 in operating expenses. So you just had a part-time employee come in and help you ship some stuff. So your $25,000 now turns into $30,000. Let's say your other expenses don't change. What happens? Now we've dropped our net profit after subtracting the operating and other expenses down to $0. You have $0 left over. You paid yourself the same amount of money. You managed almost twice as much work, and you effectively made $10,000 less. For you to have broken even with scenario one, where you charged $20 per kit and you did $100,000 in sales, you would have had to logged $250,000 in gross sales to end up with that $10,000. And really, I bet your operating expenses would go up even more. So you would have had to have sold more than twice as much and done more than twice as much work to achieve the same result at this $15 price point. I don't know about you. Maybe I'm just lazy, but I would prefer scenario one, where we charged $20 for this thing and we did $100K in sales, had lower operating costs, and ended up with the net $10,000. Because in this scenario where you're charging more and you're making more and you have more time, you might have the capacity to invest in things that are going to increase your annual revenue, as opposed to investing purely in just getting the product made and out the door. Let's say you do put some time into some organic marketing. So you write some blog posts, you do some social media posts, and you do a Reddit post that does well, and you hit that $250,000 gross revenue figure without having to lower your prices. You got $100,000 in gross profit to work with here. And let's just say you double your operating expenses. You have to hire a little bit more help, and you pay yourself more. And let's say your other expenses double as well. All right, we still have $40,000 left over in net profit, all because you didn't sell yourself short. You priced your products appropriately. You invested your time and energy into the things that matter. And by doing so, you went from just squeaking by to building something that has a real chance of taking off. If you're thinking about starting a small business and you haven't run through an exercise like this, you need to. If you already own a business and you're not doing this, you should be. Like I said, I own a business myself. I created this spreadsheet 15 years ago, and I have been looking at it weekly since I started my business. It's my number one go-to tool for making sure that I am keeping things on track. Like I said, you can find a link in the description. Thank you so much for watching, like, and subscribe. And if you found this content useful and you know someone else who might benefit from it, please share it with them. See you on the next one.